It is much more of a buyer's market right now. We have more inventory, more price reductions, room for negotiations, and all the contingencies that you want. In today's video, I'm gonna teach you tips and tricks that you can utilize for negotiating harder, getting a better price, and teaching you about ways that you can actually save money within your mortgage. My name's Monica Church. I'm a Seattle Bellevue area real estate agent. If you're new here, I make all these videos by myself, film, edit, everything. I actually went to film school before I was a realtor. So if you like these videos, please be sure to give me a comment. It really helps the video performance and it makes my day. And if you're looking to buy or sell in the area, as always, you can get in contact with me in the link below in my description. Okay, let's get into this. Tip number one, if you are in a position where you can negotiate money off the purchase price, consider asking for seller credit instead. Let's say you're buying a house and it's $800,000, a pretty typical price for a home here in Seattle. You're in a position to negotiate and you can get $16,000 off the price of the home. Well, alternatively, you can actually ask for $16,000 in seller credit. Seller credit to a seller is the same as offering less on the home. At the end of the day, it's $16,000 that they're giving you to use towards your closing costs or an interest rate buy down. We'll get into the interest rate buy down a little later, but let's start with closing costs. When you buy a house here in Washington State, at least, closing costs are about 1.5% to 2% of the purchase price of the home. Closing costs include lender fees, appraisal, title fees, prepaid taxes, and insurance. And that all accumulates to about 1.5% to 2%. With a home that's $800,000, you can expect your closing costs to be maybe about $12,000 to $14,000. Now, if you ask for seller credit, you can use that directly to pay for your closing costs. So that means that's less money that you're bringing to the table at the end of the day. Would you rather have $16,000 off the purchase price of the home that you will realize one day when you go to sell? Or would you rather have $16,000 in your pocket right now? I did the math so you can see the difference here. So with that $16,000 savings upfront in your pocket, if you were to invest that over 30 years at a rate of 7%, that would be $121,000. Whereas if you got $16,000 off the purchase price of your home, that would make your monthly payment about $85 less, which over 30 years would be saving $30,000. Saving on those closing costs first is typically more financially advantageous. Now you might be wondering, how realistic is it to get some of your closing costs paid for? Well, I actually got a home in contract this morning where we asked for $15,000 in closing costs, enough to pay for their closing costs, and it got accepted. Yay! An interest rate buy down is the number one thing that first-time home buyers tell me they've never heard of. If you're someone that is complaining about interest rates being too high and that's why you don't want to buy a house, this is your solution. You can actually get a lower interest rate. There are two types of interest rate buy downs. There is a permanent buy down and there is a temporary buy down. With a permanent buy down, a lender will give you options of upfront money that you are paying to buy down your interest rate. They do this in a currency, I guess you'd call it, called a discount point. So they might say, for $5,000, you can buy down your interest rate 0.5%. Now, with permanent buy downs, the important thing to know is if you refinance later, you paid that money up front and you're not getting it back once you refinance. So if you pay $5,000 up front and that 0.5% that you were gonna save saves you $200 a month, but you refinance after a year, you only saved $2,400 of the $5,000 you paid up front, and you actually lost $2,600. You essentially overpaid your lender because you refinance. So permanent buy downs really have to make sense. You really have to be in a market where you feel like you're not gonna end up refinancing. Now, with all the buzz constantly about maybe rates will get lower eventually, most people are not doing permanent buy downs because we just don't know what the future holds if rates are gonna go down. So instead, what people will do is a temporary buy down. And this is really cool. If I were buying a house today, this is what I would do. So how this works is your interest rate is temporarily bought down. You can do a 1 buy down, a 2-1 buy down, or a 3-2-1 buy down. So with a 1 buy down, your interest rate is 1% lower the first year, and then after that, it's whatever you had locked in at. So if you got quoted 6.5%, that's kind of today's rates. Your first year, you'd be at 5.5%, and then the next year you'd be at 6.5%. With a 2-1 buy down, your first year it's 2% lower, you'd be at a 4.5%, then your next year it's 1% lower, 5.5%, and then the third year it's what you locked in at, 6.5%. And then with a 3-2-1 buy down, yes, your rate is 3% lower that first year. That can be a significant monthly savings. A 3.5% interest rate for your first full year, so crazy. I'm gonna show you right now. Here's a breakdown of what that monthly savings can look like. It's insane. Obviously, with this, you don't want to do this if you only feel comfortable with the first year's payment. That's a horrible idea financially to do. But if you feel okay with the monthly payment that you would have at the highest interest rate possible at 6.5%, but you get to save money those first 3 years, great. But how much does this cost? A 2-1 buy down typically costs about 2% of the purchase price. So this is something to think about. You're asking for 2% of the purchase price, about $16,000, let's say, just for that 2-1 buy down instead of $16,000 off the cost of the home. So it's again one of those things. Some people decide they just want money off the cost of the home. Some people decide they want to save money up front in their monthly payment. The really cool thing about a temporary buy down is if interest rates do plummet, if 6 months from now something happens and rates are at 4%, you can refinance, and the money that you didn't realize using, you actually still get that. You get to put that towards buying down your principal loan payment. So it's kind of like it operates as if you did get a house for less money. So it's not a use it or lose it with a temporary rate buy down. Best case scenario, you use up your 3-2-1 buy down, and after 3 years, rates are lower than what you locked in at, and you get to refinance and you never had to live in that 6.5% interest rate. Worst case scenario is still a best case scenario, because after 3 years, if rates are higher than what you locked in at, well, good for you that you bought your house when you did and you got it at a rate that is lower than rates being quoted today. You're getting a mortgage, that means you're working with a lender. Lenders gotta eat too. We all have to make money in this world, obviously. So a lender is charging you fees when they're helping you get a home. Now, something to know is when you want to buy a house, they're going to give you a loan estimate, and it's going to have all the fees in there. Every lender is going to have this looking a little bit different. You're always going to save money if you shop around lenders. So don't just talk to one lender. Talk to at least 2, maybe 3 lenders. I have buyers that have talked to like 20 lenders in one day just to get the best deal on their loan fees. Every time a lender sends you a loan estimate, it's padded with fees so that they get paid more. It's padded enough where they could cut some of these fees a bit. So what you're gonna do is you're gonna decide what lender you like the most. You're gonna get your loan estimate. You're gonna take it to another lender. You're gonna ask a different lender to give you a loan estimate, and you're gonna make the lenders compete against each other to get their fees down. Once the fees are down, you go with the lender you like better. And that's it. I helped some buyers do that recently, and they saved $3,000 off their loan estimates. Lenders are very important. There are good lenders and there are bad lenders, okay? And sometimes it's kind of like a contractor, right? You don't want to go with the cheapest contractor because you get what you pay for and you might be getting the worst job done. You also don't want to go with the most expensive contractor. You want to go with the one in the middle, right? You want to go with the one with good reviews. Lenders, it's kind of the same. You might not want to go with the cheapest because they might give you horrible service. And at the end of the day, you are buying a house, you have your earnest money on the line. If you fail to close, you could lose a lot of money. So I'm not saying to just go with the cheapest lender, but just know even the best lenders, their pricing could come down a little bit. When you're comparing loan estimates, it can be confusing because lenders charge all these different fees and they vary. Like one lender might charge a $1,400 appraisal and the other is charging a $900 appraisal, but then the other might have a wiring fee of $50 and the other $200. Wiring fees wouldn't be that much, but you get what I'm saying. Like they vary, it's like hard to get the apple to apple comparison. So when you are confused, talk to your realtor about it. Show it to your realtor. They should be able to help you figure out what's the best deal. So also, you're gonna be hyper fixated on the interest rate. One lender might quote you 6.5% and the other might quote you 6.75%. So immediately you're gonna go, well, this lender's better, but you have to look at the closing costs. The lender with the lower interest rate, they might be charging you hidden fees in your closing costs up front to give you that lower interest rate. This is where things get confusing really quick, right? How are you supposed to figure out if the 6.5% interest rate's better, but you're paying some fees up front versus the 6.75% interest rate? Well, there is this thing called an APR. Every loan estimate has to have an APR, the annual percentage rate. So it wraps up the interest rate as well as any fees, and it gives you the actual percentage deal that you're getting. It's supposed to be an easy way for consumers to figure out which is a better deal. So the 6.5% with the closing costs might have an APR of 6.8% versus the 6.75% without the extra closing costs might have an APR of 6.79%. So if you get confused with all this, look at the APRs, look at which APR is lower. Next money saving hack for you. This one typically works more for new construction. So when you're buying a house, in the purchase and sale agreement, it's gonna state what items are included with the home as far as appliances are concerned. So stove, dryer, washer. It's very common in new construction for homes to not come with a washer and dryer, but you can ask for them to include it. And the way that you would do it is to simply check mark those boxes. And in the purchase and sale agreement, it's a lot easier for the listing agent or the builder to maybe not notice that you asked for the washer and dryer with just the simple check marks versus adding verbiage in an addendum saying we are requesting a washer and dryer, blah, blah, blah. So that's just something that you can do. You can try asking for a washer and dryer. Usually, I would say 9 out of 10 times, the listing agent notices it. And just because they notice it doesn't mean they're gonna say no. They might still add it in, and it's just a part of the negotiation. But occasionally, every once in a while, a listing agent actually won't notice it, which is not good. That's why it really matters who you're working with. And if they don't notice it and they agree to it, then the seller legally has to supply you with a washer and dryer. And my last tip for you is on negotiations. Negotiating the right way to squeeze out the most amount of money from that seller. Negotiations are all about give and take. You can't simply ask for all this stuff and not expect the seller to want you to have a concession as well. In a lot of the negotiations I do, it is all about having the number that you want, and to get us to that number, we have to offer lower, and we gotta do the song and dance to meet in the middle somewhere. So one way that you can squeeze more money out in negotiations is by cleaning up the terms of your offer. The cleaner you make your offer, the more money the seller is gonna be willing to part with to guarantee it's a smooth, seamless deal. They're just gonna realize that that's what they should do versus trying to hold out. So I wanna tell you about this transaction I had this year. All the neighboring homes were listed at 1.3. They all went for 1.3. This was the last home available. It had been sitting a while. They listed it at 1,195. So it was already 100,000 less than the neighbors went for, and they were literally the same house. This was a middle unit compared to the side units, but a middle unit's not worth 100,000 less, maybe 20, 30 less, but not 100. So we offered 1,097,000 with a 30-day close, which is an average closing date. So we offered another 100,000 less. And we did this aggressively knowing they're not gonna take that, but we needed to have a big gap to somehow meet in the middle somewhere. And they were already listed at a pretty good price, so I wasn't sure how they were gonna react to this. Now, they countered at 1,175. That's only $20,000 off their list price, right? That's nowhere close to meeting in the middle at all. We countered at 1,135. So we did come up about $35,000. And what we did then was we added a 23-day close. We tightened our closing timeline by 7 days to sweeten the deal for the builder, to make them feel like they're getting a little something, they can get their money quicker. And they really liked that. But then they countered again. They countered at 115. Which would have been good. That would have been great. It would have been meeting in the middle. Great, our work here is done. Good goal. But we felt like we could have gotten just a little bit more out of them. And they said at 115, this is all that they would do. That's it. Otherwise, they're moving on. But we decided to counter at 114. And then we put in a 17-day close. So we tightened our closing timeline even more. And then we stood strong on that. We said, this is our final, this is what we can do as well, right? So a little bit better than meeting in the middle, way better than all the other neighbors selling at 1.3. And we also asked for a washer and dryer. And guess what? They took it. They took it, and a huge reason for this was the shorter closing timeline that really enticed them. They were holding very strong at 115, and then once we said we would shorten our timeline for closing even more, they took the 114. They were willing to go down another 10,000 because we shaved our closing by another 7 days. That's crazy. It's things like this, it's the terms of the offer that will get you a better price or seller credit or the things that you want. So how do you close quicker? A standard timeline is 30 days. If you're all cash, you can close in as little as 7 days. If you're financed, typically lenders will tell you 30 days, but there are lenders out there that can easily do 21 days. There's lenders that can do 14 days, even 10 days. My favorite go-to lender can close in as little as 10 days. That's huge when it comes to negotiating, to know that you have that in your back pocket if you need to use it to get the price down. And then other little ways sometimes that you can get the price down, getting a little extra seller credit, tightening timelines to make a seller feel good about your offer. So rather than having a 10-day timeline for your inspection, make it a 3-day timeline. You don't need a 10-day timeline. I can get an inspector out the next day. It's just things that will allow a seller to take your offer over someone else's when your offer might even be at a lower price than someone else's, but you have the better timelines. Knowledge is power in real estate. If you're working with a fantastic real estate agent, you don't really need to know these things. They're gonna do it for you. Having a great real estate agent is also gonna save you money. If you don't know a good real estate agent, if you're not in the Seattle Bellevue area, you don't know a good real estate agent, I can help you connect with a top agent that is really good, that is going to negotiate so hard for you. This is something I do. All you have to do is email me, tell me a little bit about your situation. I'm going to give you recommendations. All right, guys, with these 4 tips, you should walk away from your home buying experience saving more money than your friend, than your neighbor. What did we learn today? When negotiating, go for the closing costs first versus the money off the purchase price. Interest rate buy downs can be great if you are sensitive to your monthly payment and want to keep that lower. If the house doesn't come with a washer and dryer, try asking for it. What's the worst that's gonna happen? They say no. Shop around lender estimate. You're 100% gonna save money doing this. It might be a couple $100, might be a couple $1,000. It's a little bit of your time. You're gonna save money. And lastly is tighten timelines as a strategy for negotiations and squeezing the most amount of money out of a seller. Thanks for watching. Now go check out some of my other videos and I'll see you next time. Bye.